Good morning. I want to welcome members of the public to this open meeting of the U.S. Securities and Exchange Commission. Today, the Commission is considering one set of matters, amendments to reporting requirements for registered mutual funds, closed-end funds, exchange-traded funds. I'm pleased to support this recommendation because it will benefit investors through greater transparency. And that's what the core of this is greater transparency into the fund's investment portfolios and improve the Commission's oversight into said funds. You know, it was a long time ago, Adam Smith, known as the father of modern economics, noted in The Wealth of Nations, this is over 200 years ago, that a whole economy benefits when the price of information is lowered, or information is even free. This is what Adam Smith wrote about. And Smith's maxim is relevant every day in our modern capital markets. Reliable, accessible data benefits everyone. And I think no one private entity, though, has the incentive to create a database with reliable, comparable, accessible data, even if they themselves may benefit. Thus, such data creates a public good. And similarly, consistent, accessible information for funds is a public good. I think overall, Congress understood that setting up the securities laws. And I believe that the Commission understood this back in 2004, when, this is 20 years ago, we first required that funds, these various, registered mutual funds and closed-end funds, exchange-traded funds, requiring investment portfolios to be provided to investors on a quarterly basis. And that's the way it is now, 20 years later. But much of life has moved on in 20 years, making portfolio data available more frequently to the public. The amendments we're considering today will enhance investors' ability to review and monitor their funds. For instance, investors could more regularly assess how their funds are meeting their own investment objectives, the ultimate investors, and to what extent the fund's portfolios might even overlap, and they might consider the competition amongst and by these funds. I think also the amendments provide the Commission with timelier information as its primary regulator of this asset management industry, and these funds are nearly $30 trillion in size overall. The Commission relies on the information in our oversight and increasing the timeliness. We currently get things quarterly. We would get it monthly now. It helps us identify risk, inform policy, rulemaking, examination, enforcement efforts. More timely fund data is particularly important in enhancing our ability to respond during times of stress or fast-moving events. We certainly lived that during the outbreak and disruptions in the markets when COVID started, when various wars started abroad, major bank failures, and we would then, in this amended situation, get monthly data on a monthly basis rather than waiting until the end of the quarter. I think the amendments also balance the benefits of timelier information with the desire to protect sensitive data. Consistent with the current rules, information will be made public only 60 days after the period when is over. The month is over, it will be made public 60 days later. Currently, that's done for the quarterly basis. Thus, funds will have 2 months before the information reaches the public. Additionally, the adopting release provides guidance related to existing rules that require open-end funds to have liquidity risk management programs. This is Commission guidance related to the rule, and Commission staff has monitored funds liquidity classifications and observed that funds liquidity risk management programs in practice, including during certain market stress events. And the guidance addresses questions that have arisen and outreach that we've gotten from market participants. I think it reflects the importance of our staff observing how rules work in practice, and then this Commission providing guidance where appropriate. I think the amendments overall will provide the public greater, more timely information and also this commission. Back to Adam Smith. I think this information will better protect investors and protect the public. But with that, I'm going to turn it over to our director of the Division of Investment Management, our head of our Division of Economic Risk Analysis. Of course, there's big thanks for everyone working on this rule, including the General Counsel and all the chair and commissioner's offices, and the whole staff list will be on our website. But over to you, Natasha and Greiner, who will give the director's statement, and I think then Alexis Hassel will give the staff statement, and then over to Jessica.
Thank you, Chair Gensler and Commissioners Peirce, Crenshaw, Ueda, and Lazarga. The Division of Investment Management is pleased to recommend the adoption of final amendments to provide the Commission and investors with more timely information about certain registered investment companies' portfolio holdings. The amendments would improve transparency and promote more effective regulatory monitoring and oversight of funds. As a primary regulator of the asset management industry, the Commission uses portfolio-related information that funds file in Form N-Port reports to, among other things, monitor industry trends, identify risks, inform policy and rulemaking, and assist the Commission staff in examination and enforcement efforts. The delay of Form N-Port data under the current quarterly filing requirement has limited the ability of the Commission and the staff to develop a more timely and more complete understanding of the market, especially during market stresses and events. Multiple market events such as the COVID-19 pandemic, Russia's invasion of Ukraine, and the transition away from LIBOR has reinforced the need for more timely data about funds portfolios. The final amendments would provide the staff with more frequent and more timely data and would allow the Commission staff to better assess potential impacts on market events affecting particular issuers, asset classes, counterparties, or market participants. This information would help us analyze the potential impact of a market event and inform whether emergency action by the Commission or coordinated interagency action may be appropriate. More frequent and more timely data would also allow the Commission staff to conduct more targeted and prompt monitoring. For instance, the amendments would help the staff identify funds that hold securities of issuers that may be under stress or affected by wider market stress events. Investors also benefit from information about funds portfolio holdings to make more informed investment decisions. For instance, portfolio information can help investors assess whether funds have portfolios that overlap, as well as how funds comply with or deviate from their investment objectives. Investors may benefit from third-party analysis of information funds report on N-Port as well. For example, analysis by data aggregators, broker-dealers, investment advisors, and others provide investment information and assistance to investors in selecting fund investments. Some investors, and particularly institutional investors, may also use portfolio holding information directly. These amendments we are recommending would make Form N-Port reports available to the public on a monthly rather than quarterly basis. Many funds do currently voluntarily disclose their monthly portfolio holdings on their websites or through third-party data aggregators. However, these voluntary disclosures are not in a standardized format, and sometimes they're only available for a fee. These limitations impede efficient analysis. In addition, some funds disclose only quarterly information about portfolio holdings. By making Form N-Port reports available to the public on a more frequent basis, these amendments would enhance public transparency of Form N-Port information and reduce information asymmetries between funds and investors. Separate from these reporting items, staff outreach and monitoring related to liquidity risk management program requirements for open-end funds identified certain areas that would benefit from additional Commission guidance. We recommend that the Commission provide guidance for funds subject to the liquidity rule to address questions raised through outreach and monitoring. I'd like to thank and add my thanks to the staff of the Division of Investment Management, the Office of General Counsel, and the Division of Economic and Risk Analysis who assisted in preparing today's recommendations. I'll now turn to Alexis Hassel from the Division of Investment Management, who will describe the recommendation in more detail. Thank you.
Thank you, Natasha. We recommend that the Commission adopt amendments to certain registered investment company reporting requirements to promote more effective oversight of the fund industry and enhance public transparency. The final amendments include the following enhancements. First, amendments to Form Import would require funds that are required to report on the form, generally registered open-end funds, registered closed-end funds, and exchange-traded funds organized as unit investment trusts, to file Form Import reports more frequently and in a timelier fashion. Specifically, funds would file Form Import reports on a monthly basis within 30 days after the end of the month to which they relate, instead of on a quarterly basis within 60 days after quarter end. Second, the Form Import amendments would increase the publication frequency of funds Form Import reports. Specifically, the amendments would make funds reports on Form Import available to the public 60 days after the end of each month, instead of providing public transparency on this timeline for every third month of a quarter only. Third, amendments to Form INSEN would require open-end funds that are subject to liquidity risk management program requirements under the liquidity rule to report certain information about service providers used to fulfill those requirements. For example, whether liquidity classification service providers are used and for which asset classes. We also recommend that the Commission provide guidance related to open-end fund liquidity risk management program requirements related to 1, the frequency of classifying the liquidity of fund investments, 2, the meaning of cash in the liquidity rule, and 3, determining and reviewing highly liquid investment minimums. Thank you for considering our recommendation. I will now turn to Jessica Wachter of the Division of Economic and Risk Analysis, who will discuss the economic impact of the recommendation.
Thank you, Alexis, and good morning, Chair Gensler and Commissioners. As you've heard, today the Commission is considering amendments to the rules governing disclosure of certain registered funds. The American public uses these registered funds to save for college, for retirement, and for other major expenses. These investment vehicles enable the public to gain exposure to stocks, bonds, as well as to derivatives and other asset classes. They enable investors to diversify their holdings, thereby achieving returns without taking on unnecessary risk. Currently, these funds report monthly holdings on Form Import. The Commission currently receives Import 4 times a year with a 60-day delay from the end of the quarter. The reporting times vary according to the specific fund's fiscal years. The Commission makes portfolio data for the 3rd month of each quarter public upon filing. As you've heard, the amendments would require funds to file their reports within 30 days of month end. The Commission would then make the reports public 60 days after month end. Due to these amendments, the Commission would receive more timely monthly information. Rather than arriving 60 days following the end of a fiscal quarter, monthly information would arrive 30 days after the end of each month. The investing public would receive monthly portfolio data as opposed to data that is non-synchronous and end of quarter. Monthly portfolio data, as opposed to a quarterly snapshot, helps fund investors better understand their fund's investment decisions. Currently, some funds make monthly data publicly available. However, this practice is not universal. Many funds do not make the data available or make only some of it available. Thus, these amendments would increase the amount of data available to the public. As you've heard, such data is a public good. Public good is an economics term. It is something that is non-rivalrous. This means that once the data is out in the public domain, anyone can use it, but it also means that private market incentives are not sufficient to produce the optimal amount of it. Each fund may benefit from making its own data public, but any one fund does not capture all the benefits, and thus funds left to their own devices produce less than what would be best from the investor's perspective. Ultimately, investors benefit from this greater transparency. These amendments come with costs. We do not expect the compliance costs to be substantial because funds already are required to determine their monthly holdings. Thus, any additional compliance costs arise from the requirement to file with the Commission in a format specific to the Form Import. Now, there may be other costs. Because portfolios would be made public earlier, some funds may decide to condense the time frame over which they build certain positions. For funds that take months to build a position, this condensed timeframe may lead to increased costs. The 60-day delay in public disclosures reduces these costs. Finally, I want to thank my colleagues in the Division of Investment Management and the Office of the General Counsel, with whom we have worked closely during the development of these rules, and thank you for your attention.
Thank you so much, Natasha, Alexis, and Jessica. Commissioner Peirce.
Thank you, Mr. Chair, and thank you to Natasha, Alexis, and Jessica. When the market's green arrows flip upside down and turn an alarming red, the demand for explanations and information is immediate. Common questions for the SEC are which funds will be affected and how significantly. We saw such calls for data and real-time analysis at the onset of the financial crisis, the COVID-19 pandemic and government response, and Russia's invasion of Ukraine. As one who seeks answers in times of market stress, I'm sympathetic to one of the stated goals of today's rulemaking, ensuring that the Commission can conduct informed analysis on funds portfolios as contemporaneous to the events as possible. But the Commission oversells the benefits of today's amendments and gives too little attention to the costs, perhaps because the Commission failed genuinely to seek needed public input on these changes. Accordingly, I cannot support this rulemaking. On November 2, 2022, the Commission proposed amendments to the open-end fund liquidity risk management regime. Largely lost amidst the vigorous debate about swing pricing and hard close requirements were the proposed changes to Form N-Port. Rather than repropose to give commenters the opportunity to focus exclusively on the N-Port changes, the Commission is finalizing modified Form N-Port without much commentary to help us weigh the costs and benefits. Had we heard more from commenters, we might have concluded that the costs of these changes outweigh the benefits. The amendments will yield benefits, but they're limited. We already collect a tremendous amount of information from registered entities, and it's incumbent upon us to make full use of it before we demand more. Funds now file Form N-Port quarterly with up to a 60-day delay. Under the new requirements, filings will be due monthly within 30 days after the end of the month to which they relate. The benefits of the change are that the Commission's information about fund portfolio holdings will be less stale than it would be under the current rule, but the information still will be stale. The Commission will receive information about what funds are holding at the time of a market event sooner than it would under current rules, but the Commission still will have to wait for at least a month for that information. In other words, the Commission, even under the accelerated filing timelines, will have to do legwork at the time of a market event to determine which funds hold what. So the accelerated filing schedule will not do much to enable the Commission to further our mission to protect investors by assisting the Commission and its staff in carrying out its regulatory responsibilities related to the asset management industry, as the release suggests. In the case of a discrete event like the Russian invasion of Ukraine, any market-wide shock would be immediate, and information still would be coming in no earlier than 30 days after the shock. Although shorter than 4 months, the 4 months that it would take under the current rule, the difference would be inconsequential with respect to the Commission's ability to do its immediate analytical job at the time of the market shock. The Commission's other functions, exams, policy formulation, and enforcement actions, all operate at a speed that does not demand immediate information. The acknowledged possible increase in data errors that the shortened filing schedule will produce degrades the reliability of the information for all the Commission's functions. The Commission already can get the information it needs in times of market stress. Under current record-keeping rules, funds maintain monthly holding information and make it available upon Commission staff request. With access to existing Form N-Port data along with discrete pieces of instructive information such as fund names, Commission staff can issue tailored inquiries concerning the makeup of relevant fund portfolios. This option, the release protests, is challenging for Commission staff, which encounters limits on its ability to identify the funds most directly affected by market stress events. The challenges to exploiting existing data may be real, but they're not beyond the talented staff's ability to overcome. In any event, those challenges will persist under the new rule, which does not provide real-time information either, nor would it be the right thing to do that for many reasons. While the benefits of an amped-up filing schedule may be debatable, the costs of these amendments are not, especially for smaller fund complexes. Industry commenters of all sizes expressed concerns about the costs of these amendments. While the Commission suggests that the costs associated with the new filing deadline are not so bad in light of existing record-keeping obligations, commenters provided detailed rebuttals emphasizing that aggregating information within 30 days for internal collection purposes, which they must do under current rules, is a very, very different exercise than preparing that information for filing. As one commenter pointed out, Form N-Port is an extraordinarily detailed report requiring funds to provide a variety of information regarding assets and liabilities, performance and flows, portfolio holdings, portfolio risk metrics, liquidity and liquidity risk management, derivatives, and derivatives risk management and securities lending. Ensuring that this complicated form has been completed correctly involves the focused involvement of multiple employees. Many of the employees charged with Form N-Port filing duties are also responsible for preparing or they have to contribute information to funds' annual and semi-annual reports, including the associated schedules of investments. In hopes of mitigating these calls on strained resources, some commenters requested an expansion of the new 30-day filing requirement to 45 days or more or maybe even more for small entities. We ignored these calls. Other commenters pointed to the less quantifiable but more fundamentally damaging costs arising from the new public disclosure rules. The amendments will make funds' monthly reports on Form N-Port public 60 days after the end of each month. Currently, only information for the third month of a quarter is publicly available. Commenters are concerned that monthly disclosure of portfolio holdings could result in information leakage that is harmful to funds and their shareholders. The risk is particularly great for certain types of funds, which is reflected in the different approaches to voluntary portfolio disclosure that funds currently take. Contrary to the comfort the Commission draws from the existing voluntary disclosure practices, the variation in practice suggests that the costs of monthly public disclosure outweigh the benefits for some funds. The public disclosure may prompt front-running and other predatory trading practices. The Commission recognizes an increase in risk for a small universe of funds, but assures us that predatory trading is not all that bad. In so doing, the Commission continues to undervalue the work that goes into deciding which securities to buy and sell. Capital markets participants should be rewarded for good investment decisions and punished for bad ones. The release threatens this broader principle of market discipline. One of the justifications for the change is that we need information during times of market stress so that we or our financial regulatory colleagues can do something. That something is likely to be a bailout of some sort, and then our friends on the Financial Stability Oversight Council will use that rescue to argue for more control over open-end funds. Changes like the ones we're making today set the groundwork for replacing market discipline with regulatory micromanagement. On the positive side, in addition to the rule changes, the adopting release includes new guidance to clarify a number of issues related to the liquidity rule. I hope that this guidance is helpful and that we remain attentive to industry calls for clarity following the issuance of these amendments and guidance. Despite my inability to support this rulemaking, I couldn't be more grateful to the Commission staff for their demonstrated care and professionalism. The women and men of the divisions of investment management and economic and risk analysis, as well as other parts of the Commission, have done their best to address commenters in their formulation of these final amendments. I'm particularly grateful for their patience. Despite often punishing drafting schedules, they never failed to respond to my many questions promptly and thoughtfully. I do have several more questions at this point. The first is, as we collect more and more information from registered entities on more compressed timetables, I'm increasingly worried about our ability to protect that information. What assurance can we provide to regulated entities that we're taking every effort to protect their confidential information?
Thank you, Commissioner, for the question. We agree that protecting confidential data, including data on Form N-Port, is critical. The Commission has experience receiving and maintaining sensitive portfolio data on EDGAR, including Form N-Port data. To that end, the Commission employs an array of actions to safeguard and protect the confidentiality and security of this and all other information reported in EDGAR. In addition, the Commission has engaged in a multi-year, multi-phase effort to modernize the EDGAR system, including both internal and public-facing components.
Yeah, well, I hope that we'll continue to focus on not only protecting the data that we get, but really thinking carefully about which data we need to collect in the first place so that we don't have to protect more data than necessary. A 45-day lag between the end of the month and the form import due date as compared to the 30-day lag that we're adopting would have helped to mitigate any damage should information be misappropriated from form import. Why not adopt a 45-day lag?
We are recommending a 30-day deadline to balance the Commission's need for tiling information with considerations about the time and cost for funds to gather and file information accurately, as well as the sensitivity of the information. This timeframe is consistent with the Commission's historical determination that access to form import information no later than 30 days following the month end is important to further our mission to protect investors. Our more recent experience also in responding to market crisis supports the need for timely data, as I've noted earlier. Ultimately, we believe the 30-day deadline strikes the balance amongst all of these concerns.
Yeah, I think that an extra 15 days wouldn't hurt us and could be quite helpful for funds for a number of reasons, including protecting the confidential information for a little while longer. Commenters also raised concerns about the increased threat of predatory reporting from the enhanced public reporting requirement. In the release, we say that minimizing the risks of exposing funds to predatory trading by delaying public reporting by 60 days is enough, but funds respond that it may not actually be enough for certain kinds of funds, and that there might be funds for which a longer time is needed before they disclose their positions. What would you say to those funds?
I'm happy to take that question, Commissioner. So when we talk about predatory trading, we're talking about the price increase that might follow the public disclosure of a fund's position. So the idea is that a fund has established a position, there's 60 to 90 days before that fund position becomes known to the public. Once that fund position becomes known, investors can trade on it, potentially leading to an increase in price. So at that point, if the fund were to increase its position, it would be doing so at a higher price point. So that's the concern that the commenters are raising here. So noting, however, that the fund is benefiting from that increase in price, it's basically as if the fund is enjoying the benefits of the price increase sooner than the fund would be otherwise. So while it is true, while we do acknowledge that there may need to be some compressed trading for certain funds, what we're talking about is we're still compressing it within a time frame of months.
Yeah, no, I understand what you're saying, although I think that this idea that a fund might benefit from predatory trading or from trading on the information that they're building a position in a particular security sort of runs counter to a lot of trading strategies, which when an investor is trying to build a large position, they don't go out and announce to the world, we're trying to build a large position in this, because they know that will mean that they'll have to pay more to build that big position. And I think what we're doing here makes it much harder for them to do that. And so I think we really need to recognize that there's a very potentially a very big cost associated with that, particularly for certain kinds of funds. And I think that's something that maybe we downplay in the release. One other piece of this is that funds can shield strategies for a year by reporting as miscellaneous securities an aggregate amount of portfolio investments that doesn't exceed 5% of the total value of the fund's portfolio investments. Why 5%? Is that sufficiently high?
And I will be glad to take that question, Commissioner Peirce. So as Jessica covered, the recommendation really includes two mitigants with respect to predatory trading. One, a 6-day delay, and two, the 5% miscellaneous security provision that you're focusing on here. For some context, the Commission initially included that 5% provision in form and import when it was initially adopted to deter predatory trading practices. And we've now had some number of years of experience with this provision, both in import and other contexts. And we believe it remains appropriate and that it, in conjunction with the 6-day delay, helps to deter predatory trading here. And I think your question really is focusing on just the 5% level, for this in particular. And I think our perspective is that the level of the ceiling really does represent sort of a trade-off between transparency on the one hand of the fund's positions, and on the other hand, the capacity for funds to build this position without public disclosure. And in some, we thought the 6-day delay plus the 5% miscellaneous provision struck that right balance here.
Okay, thanks, Brian. Another issue that I had that I raised in my statement and really concerns me is more of a procedural issue. These amendments were originally proposed in conjunction with a lot of other amendments that were quite substantial. Change would have been, if we had been moving forward now, would have been very substantial changes. So do we really think that we gave people enough time to focus on these particular amendments? Did they maybe get lost in the context of that larger proposal? We did get a number of comments for which I'm very, very grateful and were very helpful to me as I thought about these changes. But I think if we had really allowed people the time to focus on this particular set of amendments, we would have gotten more feedback, which would have been quite helpful. So why didn't we pursue a reproposal?
Thank you, Commissioner. I can address that question. And I appreciate your question as it relates to a potential reproposal. These amendments, although part of the broader proposal, were, we believe, well understood in the comment file. We received comments from different perspectives on both the cadence of filing import and the proposed increase in transparency. And we're recommending today an adoption of these amendments, which are substantially as proposed with modifications as suggested by these commenters. So again, we didn't feel that it was necessary to repropose at this time.
And then finally, and I think this question is probably for Jessica, I'd like to understand what the consequences of these amendments are. What are your plans for setting up a retrospective review to see what kinds of effects these amendments have had after a few years?
Sure. Well, we are always interested in how our rules will work out. And so we're going to keep many things in mind for the future. So one point is that there is a literature about how funds currently manage the quarterly disclosure of information. And one finding is that it leads to actually reduced informativeness of prices around quarterly disclosures. So I think that the first question is whether relative to the baseline, the end of quarter price informativeness would rise. That's one thing that we would expect to see because the quarter becomes less salient as a date. So I think that the next thing we might look at is price reactions to fund disclosures to see if they're amplified or muted. And then finally, as I'm sure you know, there's quite a large literature on fund performance that uses many methodologies, including import data. And we could certainly look to see if there would be a decline in fund performance and whether that varied by different types of funds.
Thank you very much. I don't have any additional questions at this moment. Thanks.
Thank you, Commissioner Peirce. Over to Commissioner Crenshaw.
Good morning. Thank you. Today, the Commission addresses several important matters. Most prominently, as you've heard, we update Form import. Import collects core information from registered investment companies about funds and their portfolio holdings, including, as you've heard, information about counterparty and sector exposure, liquidity, volatility risk, leverage, and net asset value. It provides the Commission with critical data, especially in times of market stress. The problem with the form as it exists now is the infrequency of the reporting. Today's amendments are aimed at fixing this timing issue. Getting data on a more frequent basis means that where there's potential for market disruptions, again, as you've heard, like those resulting from COVID or from Russia's invasion of Ukraine, or the LIBOR transition, or regional bank failures, our staff will be armed with more current and critical data to assess rapidly developing situations and craft targeted responses, instead of either relying on information that is up to 5 months old or starting anew by sending out mass data requests to registrants at a time that could require more immediate action. We need sharp tools to protect investors and markets when circumstances are most volatile, not tools dulled by the passage of time. Putting current fund data into the hands of our capable staff to help avoid mass investor harm is a step that I am happy to support. More generally, the provision of data on an improved timeline will enhance our oversight and monitoring of funds, even in non-volatile times. Likewise, today's amendments will require funds to make public their monthly portfolio holdings 60 days after month's end. Giving investors the ability to see more information about their holdings in registered funds is common sense to me. This will allow investors to better assess their investments, either on their own or with the help of third parties, make informed decisions about their money and long-term plans, and assess whether fund managers are hewing to their stated investment and risk strategies. Many fund managers currently understand that fund transparency is good for business, as they already voluntarily provide such information. Today's rule will provide investors with conformity, consistency, and clarity. I understand the concerns that we've heard from certain fund managers relating to difficulties they may encounter in building or liquidating positions or in copycat trading as a result of public reporting. The final rule endeavors to mitigate those concerns. For example, as you again have heard, there's still a delay in reporting. That delay has simply been reduced from up to 5 months to up to 3 months. Moreover, the funds will still have the ability to anonymously build a position up to 5% of their portfolio. And as always, there will be an opportunity to report back to the Commission on real-world experiences after the rule becomes effective. Additionally, today we provide guidance on liquidity rules for open-end funds. Today's guidance relating to the required frequency of liquidity classifications, the definition of cash, and highly liquid investment minimums is based on the staff's ongoing observations, outreach, and monitoring of the industry. I support all the measures we adopt today, which provide for greater transparency to both the Commission and the public, clarity to the industry about their practices, and hopefully overall safer and more robust markets. With that, thank you to the staff in the Division of Investment Management, the Division of Economic and Risk Analysis, the General Counsel's Office, among the many others who crafted this important release, which helps us fulfill our mission. Thank you.
Thank you, Commissioner Crenshaw. Commissioner Ueda.
Thank you, Chair Gensler. The recommendation before the Commission today is to adopt certain changes to Form NPORT and Form NSEN and provide guidance to funds on certain aspects of their liquidity risk management programs. Form NPORT was adopted in 2016 and made important changes to the information collected by the Commission about funds. NPORT requires funds to report individual portfolio holdings, risk metric calculations, and other information. Currently, funds file Form NPORT for each month in a fiscal quarter within 60 days of the end of that quarter. The third month of each fiscal quarter is made available to the public, while the first and second months remain confidential. In response to financial stability concerns, there's been an increased demand by prudential regulators to know market-wide positions held across funds in recent years. Today's amendments would require this information to be reported to the Commission within 30 days after the end of each calendar month, providing faster regulatory transparency to fund holdings and information based on timing that is not dependent on a particular fund's fiscal quarter. Had these amendments been limited to such regulatory transparency, I could have supported them. However, The amendments also require that monthly Form N ports information be made available to the public 60 days after month end. This means detailed fund holdings will be made publicly available 12 times per year. Why does the difference between regulatory transparency and public transparency matter? Why does the difference between 12 public data points per year versus 4 public data points per year matter? Well, it's because fund portfolios represent the intellectual work product of their investment advisors. Thus, the idea that fund advisors need to provide their investment ideas to the general public for free is highly concerning. If fund advisors are not compensated for their skill in conducting fundamental investment research and effective trading strategies, then such efforts will be less likely to occur at all, and the public good of price discovery will be significantly harmed. The Commission has not adequately justified the decision to substantially increase the frequency of public disclosure of Form N port data and makes only cursory efforts to reverse a policy considered less than 8 years ago. Commenters, including asset managers that pursue an active management investment style, raise substantial concerns about the harmful effects that such public disclosure could have on fund investors. For example, asset managers that follow a value style may take months to build a position, and their decisions are based on narrow, predetermined price ranges. Similarly, some funds have a focused portfolio consisting of a handful of companies, in which each investment decision is highly impactful. As such, public disclosure of Form N port data raises the risk of predatory trading, where the manager's careful investment decisions can be easily and cheaply copied. Further, I am concerned that more frequent disclosure of portfolio holdings can put the fund at a disadvantage relative to other investment pools that compete in such markets, such as hedge funds, family offices, and collective investment trusts that are not subject to these requirements, and not to mention separately managed accounts. This may be particularly acute for funds that invest in high-yield bonds, where counterparties and other market participants may seek to benefit from information that a fund is building or selling a position, thus exposing the fund to wider bid-ask spreads and lowered performance. The Commission's decision to minimize these concerns is puzzling. Form N port, as the Commission has repeatedly observed, is primarily designed to assist the Commission and its staff. It is not retail investor friendly. Instead, the Commission believes that individual investors will benefit from third-party service providers that aggregate and analyze that data and sell it for a fee, as well as the efforts of academics. The Commission summarily dismisses the concern that a fund's portfolio can be copied, merely because of the 60-day lag, and points to the fact that some funds voluntarily disclose portfolio holdings on their websites in support of more frequent portfolio disclosure to the public. However, the information that funds publish on their websites is not the same as required on Form N port. It may consist solely of the top 10 holdings or exposures to different sectors. Form N port information includes not only all of the fund's portfolio holdings, but also information on risk metrics and other data. But more importantly, just because some funds have decided that the benefits of public disclosure outweigh the harm does not mean that we should mandate more frequent disclosure for all funds. These concerns are heightened given advances in artificial intelligence, the availability of fractional shares, and the ability to buy and sell them through electronic trading platforms with no commissions, and the increased use of structured data, including as required by the Federal Data Transparency Act. This means that it might be even easier in the future to copy the investment strategy of a successful fund manager. Artificial intelligence could peruse the monthly holdings of all funds using structured data and automatically follow the fund advisor with the best performance at the moment. Mobile apps from brokerage platforms can offer the ability to hold a portfolio that mimics one's favorite investment manager using fractional shares and zero commissions, avoiding the payment of any fund fees to do so. Similarly, The Commission assumes that public disclosure of monthly portfolio holdings may benefit fund investors. Well, I don't think this is true. What would be the basis for that belief? Well, it stems from my involvement as the Assistant Director for Disclosure Regulation in the Division of Investment Management, where I participated in extensive retail investor testing of information contained in fund shareholder reports. The results were not surprising. Fund investors were most interested in performance, and they were far less interested in a complete listing of portfolio holdings. Many fund investors were more interested in understanding portfolio holdings by category, which is, in fact, information that is not even disclosed in Form N-PORT. I highly doubt those investor views have changed since then. But if the Commission wanted to know, it could have easily reconstructed and conducted a new round of investor testing before charging ahead as we're doing today. Fund investors could be harmed by increased trading costs, as managers may try to concentrate their trading activity within a shorter time frame or otherwise change their strategies to protect fund shareholders from the effects of predatory trading or less favorable bid-ask spreads. This may result in decreased fund performance, which could cause these fund investors to redeem from these funds and could lead to a fund's eventual liquidation. When an investor can obtain the same portfolio exposures as a fund manager for free, well, what's the incentive for the investor to even invest in the fund to begin with? The Commission's decision to require more frequent disclosure publicly of certain Form N-PORT information may have broader, unwelcome implications for investor choice and the diversity of our markets. Index funds and index-based investing have grown in popularity, and actively managed fund assets may be declining. Some of this decline may be due to market forces. It can be difficult to compete with index funds with enormous economies of scale that can be managed at low cost. In this regard, I've repeatedly voiced my concerns that the rules imposed over the past 3 years can have a disproportionate effect on smaller asset managers, which include many active managers. Whether intended or not, the Commission should not be implementing a regulatory regime that favors passive investment strategies over active management strategies. Lastly, I reject the premise that frequent public disclosure of consistent information made available for all funds is a public good. The capital markets function efficiently because there are financial incentives to conduct value-adding fundamental research for securities and their prices and valuation, which is one reason for the very existence of fund investment managers. The results are the intellectual work product of the fund manager and its skill. That information is not a public good to which everyone may have access for free. While the active management itself, that very act, is a public good, given that it contributes to price discovery. Thus, with this rulemaking, we run the danger of undermining the true public good at issue here. Although I cannot support this rulemaking, I appreciate the efforts of the Division of Investment Management, the Division of Economic and Risk Analysis, as well as the Office of General Counsel, and the many others who have contributed to this effort. I also recognize the efforts of the other offices that have contributed to these proposals, as well as the analysis of all the comments that were made to some of the broader proposals originally made that we are not acting on at this point today. Thank you. I don't have any questions for the staff.
Thank you, Commissioner Ueda. Commissioner Lizarga.
Thank you, Chair Gensler. Thanks to the staff for their presentations and for their work on this rule. Under current rules, registered investment companies, a $28 trillion industry of largely mutual funds and exchange-traded funds, provide the Commission and investors with periodic portfolio holdings data. The Commission relies on this data to assess trends and risks and to support its rulemaking, examination, and enforcement efforts. Institutional and retail investors benefit from access to the same data that can help them make more informed investment decisions. The current rules could impact millions of US households and possibly even over 100 million retail investors that invest in mutual funds and other products. Concerns about whether data provided under current timelines renders some of this data stale, both for oversight and investment decision purposes. So these concerns are well-founded. Delayed information in the context of the COVID-19 pandemic and geopolitical events and other market stresses in recent years has limited the Commission's timely understanding of the market impacts of these events. More importantly, investors are left to make decisions with incomplete or outdated information. Data aggregators and other market participants can be a source of some information for investors, and many funds voluntarily post periodic information on their websites or through third parties. But practices vary. The data provided is not standardized, often lacks risk metrics, and may only be available for a fee. If adopted, reforms that yield more timely fund portfolio information will no doubt help the Commission better assess the impact and risks of market stresses, closer to when they are unfolding. Relative to the status quo, today's reforms will also offer investors more timely access to data. But the current framework, where investors gain access to the information much later than the Commission, will remain unchanged. That is, fund information will be made public on a 60-day delay, leaving investors at a significant disadvantage. In light of this disparity, I urge the Commission staff explore future amendments to this rule so that investors can benefit from more timely access to fund portfolio data. As I see it, fulfilling the investor protection part of our mission means elevating the interests of investors, retail investors in particular, to the forefront. Today's reforms fall short of that, but I'll support them because taken together and on balance, the reforms represent an improvement over the current rule. Thank you.
Thank you to all of my fellow commissioners. With that, I think that I will call the vote on the amendments to form NPORT and the attached guidance that has been recommended by the Commission, by the staff. How do commissioners vote to approve the amendments and guidance?
No.
Yes.
No.
Yes.
Yes, the ayes being 3-2, the amendment is approved. And with that, this concludes the business of today's agenda, and the meeting is adjourned. Thank you, everybody.